Let's try and understand what really is happening at the Brigade Group, be it the realty business, now that the IT sector and employment has seen a very strong recovery. How is that impacting their businesses? Joining me right now on the show, we have with us Atul Goyal, the CFO at Brigade Group on the show. Mr. Goyal, great to have you on the show. You've had clearly a very strong second quarter performance. But what about the improvement in the third quarter? Do the numbers continue to ride up?
Good morning. Yeah, definitely quarter three looks to be very good. I think we should be maintaining the run rate, what we have been doing in resi business. Of course, office is also now improving. I think today you have seen an article in ET that offices are now mulling to come to the offices and maybe on the hybrid matter, at least 2-3 days in a week, they will come. So I think this will all drive demand. Demand is coming back. I think we have closed some of the deals which we'll be declaring during our quarterly results. But yes, office looks promising right now. Retail has done very, very well from our side. I think pre-COVID consumption is more or less back, and I think retail rentals are also will be back to pre-COVID levels by March end. Hospitality is one area where we have seen some negativity, but now after second wave, the things have been improving. We are achieving more than 45% of occupancy, though ARRs are still 60% of the pre-COVID levels. But I think things should improve from there if we don't have a major impact of Omicron, which is there. But overall, good business scenario, and I think we should do well ahead there.
Right. Atul, the other thing is that given your presence across segments, I mean, it's not just real estate, but it's residential within that. You're present in hospitality as a sector as well as retail. Does residential demand continue to see the strongest boost?
Yeah, definitely. I think residential demand definitely is very, very high. I think it's a cyclic business, and I think cycle is returning. There are also some reasons for that, which is consolidation, of course, in the industry. Because of this, all the listed and A-grade developers are getting higher shares, and of course, affordability in the sense that they are so low rates of loans, and of course. Now more regulatory aspect in the real estate has definitely bring in interest of the buyers, and I think residential demand is going to stay in, and our focus will be there in residential more by the time other businesses improve.
While demand is coming back, there is also a big uptick in cement cost, steel cost, construction cost, labor cost. So are we going through a patch where top line will look great, but bottom line will not look great?
I think, yes, you are right. Prices have increased. I think steel is the major concern where 50% prices have increased. Cement has been varying, but it's not a very much. Of course, other tiles, pipes, everywhere, 15% rise in price increases there. So overall, there has been an increase of 7-8%. And I think developers are trying to pass on this price increase to the customers. We have taken at least 4 to 5% of price increase in last 2-3 months, and will continue to do that. See, in Bangalore, anyway, it's a volume market. Margins are thin, so there is no option but to pass on that increase in input cost to the customers, and customers are accepting it. That's how we see it right now.
In 2022, do you expect prices also to go higher? And would you be considering price hikes? Because ultimately you are in a business, sir, and business is a function of demand and supply. If demand is coming back, are you in a position to start increasing pricing?
I think so. I think, see, today developers are conscious of price increase because demand has come after a long time. So the market will tell, but if demand is there, definitely price increase will happen, maybe due to input cost or due to the increased sale. But yes, definitely I see at least 4 to 5% of price increase, at least in South market year on year going ahead.
Projects which you have, would you be consciously now, let's say, If tower A is complete, tower 2 you'll increase prices, or if there is a project in the nearby area, you'll consider a price hike, and you think that will be absorbed? I'm just trying to perhaps ask you a very basic question, trying to understand where pricing is headed.
No, definitely. I think this we have been doing last year. See, today RERA allows tower by tower registration. So every customer, at least every developer, and at least we also have been registering our overall project and doing a tower to tower RERA registration. So definitely it depends upon the demand. If demand is there, price increase has to be there, and we are doing it. And it also, you have to see what are the basic amenities, and of course the sizes of the apartments. I think 3-bedroom apartments are more premium today than 2-bedroom or 1-bedroom. So I think this is all a mix of the project, and that depends from project to project.
Interesting. Wanted to understand what really is happening, Atul, with the hospitality business as well, because we've seen a countrywide recovery, but just wanted to understand from you, what is it that you're witnessing? Because the reopening, I'm guessing, must have quite aided the occupancy levels.
Yeah, it has aided occupancy levels, definitely. Corporate travel is also back. Overall travel is there now. So occupancies have definitely increased. As I told you on my opening comments, 45 to 50% of occupancy has been there, but ARRs are still low. They are still at 60% of pre-COVID levels. Slowly, they are also increasing. So I think within 1 year, hospitality should be in line, and they should do well. And one added advantage to the existing hospitality people will be that there are no more inventory which is coming in the market. So people who have investing present inventory will definitely benefit in future.
You know, that's the other thing that I wanted to talk about with you, the kind of inventory levels that you're sitting at, and wanted to get a sense whether or not there's been a meaningful reduction there too, because I recall, you had high inventory levels earlier, which were a bit of a concern, but I'm sure all of that is getting corrected now.
Yeah, definitely. I think today the questions have been reversed from analysts. They ask why you are not doing more launches, because the inventory is reducing very fast. In fact, our finished inventories, more or less, it has been into the 0.2 million range, and of course where the project is going, where we are doing the construction, overall unsold area is only 6 million. So we don't see any challenge there. Definitely inventory reduction is there, and we hope that we'll do more launches to cover up this inventory reduction.
So A, the launches which are in the pipeline, and B, given that real estate demand is that strong, have you reached the point, because of the raw material cost price pressure as well, that you are actually seeing an uptick in prices?
Definitely, we are looking at uptick in prices. You can see every developer is taking that increase in prices to 4 to 5%. As I said, we have already done 4 or 5%, around 5% of increase in various projects to cover up the input price. Secondly, for launches, we have targeted around 2 million of launches in the coming year, and maybe in the next financial year, we may target around 4 to 5 million. So that depends upon how the market is going and how the market is responding to the demand.